April 2nd, a day Trump nicknamed Liberation Day, a game-changing moment in global trade history. The United States, under President Trump, declared an aggressive tariff policy, 10% universal import duty on all goods, with even higher rates for 60 nations. India, with an average tariff rate of 12% compared to the US's 2.2%, was labeled by Trump as the tariff king, a country that, according to him, heavily taxed American goods while enjoying easy access to the US market. But how did this trade war escalate, and what does it mean for investors and businesses? Let's break it down. India exports nearly $74 billion worth of goods to the US annually, including gems, pharmaceuticals, and petrochemicals, while the US exports $42 billion to India, facing higher tariffs. With trade tensions rising, the impact on stock markets is inevitable. Here's how different sectors are reacting. Commodities. U.S. demand for Indian steel and aluminum drops due to higher import costs, substitution with other suppliers, and slower economic growth. Example, Tata Steel and Hindalco face declining U.S. orders. FMCG, fast-moving consumer goods. Higher import tariffs make American luxury brands expensive, pushing Indian consumers towards local alternatives. Example, ITC gains as imported packaged foods face higher costs. Its sector. U.S. firms facing higher costs may cut back on outsourcing, slowing revenue growth for Indian IT giants. However, demand for cybersecurity and AI solutions could increase. Example, Infosys and TCS see slower expansion, while cybersecurity-focused companies like HCL Technologies gain new opportunities. Banking and financials. Investor uncertainty creates short-term market volatility, but government incentives for manufacturing and defense boost sector resilience. Example, SBI and HDFC Bank gain from increased defense and energy sector financing. Textile and apparel. Despite the 26% tariff on Indian textiles, competitors like Bangladesh, 37%, Vietnam, 46%, and China, 52%, face even higher tariffs, making Indian manufacturers relatively competitive. Automobiles. A major setback as the U.S. imposes a 25% tariff on foreign automobiles and auto parts. Companies heavily reliant on U.S. exports face the biggest risk. Example, Tata Motors struggles to inject Kroger's significant U.S. market share. Remain largely unaffected due to their domestic focus. Defense industry. Increased U.S. defense imports indirectly boost Indian manufacturers as India ramps up local production to reduce reliance on American arms. Example, HAL and Bharat Dynamics benefit from government contracts for indigenous defense manufacturing. Renewable energy. Rising trade tensions encourage India to reduce energy dependency on the U.S. and expand domestic capabilities. Example, Adani Green Energy and Tata Power benefit from government incentives for solar and wind energy projects. While some sectors suffer, others present investment opportunities. The key? Staying informed and making smart financial decisions. If you found this breakdown valuable, don't forget to like, share, and subscribe for more deep dives into global economics and market trends.